Well, you guys, for those of you that have attended the Impact Investment podcast before, welcome back. I saw a lot of new people registering for it yesterday, so we're excited about that. We love to grow this database of people that are attending our podcast. We hope you find it useful and educational, so we will continue to do it as long as you guys are enjoying it.
Absolutely.
Yeah. So Erik's going to give us a few updates on the market. We did not do a podcast last month, so we've got a lot of things to catch up on. So Erik's going to just kind of bring us up to date on what's going on in the marketplace right now, and then we'll segue into some things we want to talk about the fund.
Some real estate stuff, yeah. So let's do that. Let's do a market update. Markets continue to edge higher on the backs of the job market, especially low interest rates, and increased optimism in regards to trade, specifically with China. The Dow Jones, 22.4% for the year. S&P 500 is sitting at 27.3%. And the NASDAQ beating them both out, which is typical at 29.8%. So a 30% year is huge. How long that lasts, nobody really knows, but it's definitely been a robust year for the equities markets. Treasury yields continue to widen, which is also a very positive thing. The 3-month coming in at 1.56, the 10-year coming in at 1.85, and the 30-year coming in at 2.26. So while the Treasury yields do continue to widen, it's easy to see why the majority of the investing public is yield starved, as they say. The big things that happened since our last podcast, 266,000 new jobs in the month of November, far surpassing estimates. Needless to say, that is huge, especially since we've been sitting at this 50-year low for unemployment for some time now. So for us to see these huge numbers continue to come by way of the job market is really phenomenal. This is really cool, Heather. Saudi Aramco is going public today, and at a $1.8 trillion valuation.
Wow.
$1.8 trillion. Okay, this is good. So they're edging out Alibaba, which is, the Chinese Google, if you will, edging out them for the largest IPO in history, in world history. So pretty big day for that. For those that don't know, Aramco produces and pumps Saudi oil to the rest of the world. They only floated 1.5% of their shares to the public markets. 1.5, that's it. So 0.5% to Saudi citizens and residents, and 1% to institutional investors. Even with that very, very small float of shares, they raised $26 billion. Wow. Putting their valuation right at $1.8 trillion, which is $600 billion more than Apple and Microsoft, rounding out the only 3 companies in the world with a market value or a market cap over $1 trillion. Some potential headwinds, really not a lot. The FOMC meets today for their last policy meeting of the year. It is anticipated that they're probably not going to signal for more interest rate cuts to come. But we'll see how that plays out this afternoon. Something to watch, something I've been watching, the Fed continues to pump, $60 to $70 billion worth of liquidity into the markets on a monthly basis, topping out or surpassing the $400 billion mark, which is interesting to be that aggressive in their liquidity policy when the economy's humming along so nicely. The Fed says it's not quantitative easing, although it sure looks a whole lot like it. So interesting and definitely something to watch moving forward to see if they continue to keep this policy going. But needless to say, banks and lenders across the world are seeing really, really high demand and are meeting that demand, which is a good thing. And consumer spending is still humming along.
Yeah. Well, with rates staying low, it has created a lot of opportunities for our funds because, as some of you may know, we are active in the real estate market, in our local market. And one of the things that we target are first-time home buyers. And with the rates staying low and there is so much opportunity for people that are looking to purchase or refinance, it's been really good for our fund in the ability that we've been able to sell these properties.
Yes.
So, and that's a great segue, because one of the things that we've been talking about a lot about at our company, and I think you've probably experienced this because I have, a lot of investors that are looking at either buying notes or going into the fund, one of the big questions I've been getting a lot of is, what's going to happen with the market? What are you guys going to do? How are you going to plan if the market shifts? And there's a lot of opportunities when markets change. I think things are still fairly good right now, especially in the markets that we're buying these real estate assets in. But it's important, I think, for you folks to understand what our credit box is and what we encourage our students to go look at when they're buying these properties, the credit box that we follow when they're trying to get loans through Cogo, which these loans are the loans that we fund on the fund. And this is the credit box that we follow when we're buying these properties. So I think it's an opportune time to talk about that, because I don't know about you, but I've been getting a lot of questions about that.
And almost daily, and it's good to point out that our credit box changes. As a lender, depending on what's going on in the marketplace, our underwriting standards continue to evolve, just depending on what's going on. So I think Heather's going to touch on some changes that we've made, why we've made them, and how it's not just self-serving, although obviously, you have to act in the best interest of your lenders, which for us is our investors. But I think she's going to touch on why we changed and how that benefits the borrower, not just the lender.
Yeah, well, I mean, one of the things that we pride ourselves on here too is, as a lender, it's not also important for us to only, get these yields for our investors, but it's really important for us also to set our borrowers up for success. Right. And be able to be strategic in the event that the markets change. So, one of the things that we feel real strongly in is we only lend on residential units, 1 to 4 units. The ultimate sales price cannot exceed the FHA maximum. And I'm going to go into these things a little more in depth as to why we feel this way. Square footage on the home doesn't exceed 2,800 square feet. It cannot be bigger than a 5-bedroom, 3-bath. And is not more than a half an acre. And if you look up on the screen, we're going to put a PowerPoint up. We actually have a link to the FHA loan limits. Every area is different. I know that in the Spokane market, I believe it's about $340,000. And the reason that we follow those guidelines with the FHA limits is it's easier to sell them. So as a borrower, if you get into a pickle and you find it, hard to sell it, you can adjust if you're staying under that FHA limit. And as a lender, you're more secure buying a note that is structured that way. So we'll go into a little bit more detail about that. We do believe that real estate, regardless of the market cycles, that there's a place that brings consistent and timely returns. So we will still continue to be in real estate. One of the things that our CEO, Lee, strongly believes is in a downturn market, it's a huge opportunity for investors. So always align yourself that you're in a position, whether you're investing in our funds or trying to do this yourself, that you're in a position to take advantage of opportunities in a downturn market, because there is a lot of opportunity for that. You can think of it as a box. Economists call it the fat part of the curve. Real estate investors call it the sweet spot, where most of the buyers are, where properties sell the fastest, and where your margins can be the greatest. I think one of the key things there is selling these properties quick. When you're staying within this box and this criteria, the properties sell faster. There's more buyers in that area and whatnot. Cogo Capital is putting our focus on the sweet spot. This is our credit box. And this is to maximize your profit with our 5-point criteria system. So again, sales price at or below FHA Cap. This is the Federal Housing Administration, and it has a maximum loan amount in each real estate market. The reason that we say to stay under that cap is because if you don't, then you're going into a jumbo loan. And your
buyer pool.
Yeah, your buyer pool goes down immensely. I think Lee was saying that 80% of home buyers are FHA approved.
Mm-hmm, right. That's huge. That's the biggest one.
Yeah.
For sure.
And we've seen that with the houses we've sold in the Spokane market. Majority of home buyers are looking for a home under this capped amount. If you're selling a home, it is where you want to be because it has the greatest potential for a quick sale. FHA loans bring homeownership into reach for first-time home buyers. This is a huge one. We typically aren't buying houses where the sales price is higher than $250,000. At least in our market, that's a great sweet spot for first-time home buyers. It's also important because homes above the FHA cap are statistically more likely to experience drastic fluctuations in value. So your higher end homes, number one, your buyer's pool is much smaller, but when the markets fluctuate, those are typically where you see those values drop.
And we see it all the time. We see it right now. Look at Orange County, California. Look at South Florida. Look at New York City. Look at the high-end real estate markets. They're always the ones to swing. The standard deviation is a lot higher in those markets than it is in a place like Spokane, Washington, or Denver, Colorado, or Salt Lake City.
Absolutely.
So,
yeah. Property types: 1 to 4 units and under 2,800 square feet. Single family and small multifamily real estate is your best bet when there is a market uncertainty. Small unit properties mitigate the risks you find in large multi-unit properties. We do not encourage people to go over 4 units. And that's 4 doors. That could be duplexes are included in that, a fourplex, something of that nature.
Well, anything over, if I'm correct on this, anything over 4 is commercial, yeah?
Yes.
Okay.
Yep.
So whole different ballgame.
Whole different ballgame. The old adage, "Don't put all your eggs in one basket," is increasingly true in the current evolving market. This is important. When you invest within these parameters, you can attract a larger segment of the market, including, again, FHA buyers. This increases your ability to appeal to more people. So, again, property types need to be 1 to 4 units and under 2,800 square feet. 2,000 square feet. That doesn't mean that if we get a borrower that comes to us that has borrowed 5 times from us and they've got 800 credit and they're going to put $50,000 down, that we wouldn't consider looking at a house that's 3,500 suite. 3,500 square feet. But these are the parameters that we go by, and there's always exceptions to the rules. Property types. Fix and flippers will find that rehab costs and extended work schedules can balloon in bigger properties. I've seen that happen. We've actually experienced that here at the corporate office, and we quickly got out of those houses as fast as we could and went back down to our nitty-gritty.
Yeah, have you ever heard of the real estate investor that finds out that their property needs a new pool? Yeah, that's a problem.
Yes. As property size increases, so does the risk that a property will turn into a money pit, and we can vouch for that. With time in rehab and time on the market creating a huge drain on resources. And that's one of the things, at least in our local market where the fund is investing in real estate, we find that those higher end homes, they're harder to sell and they take longer. The people that are actually purchasing those homes are a lot pickier. They can afford to be. And so they just, the amount of time that those things sit on the market until you find that right buyer just drains you from a holding cost standpoint.
So true.
So no more than 5 bedrooms and 3 baths. Millennials and boomers are the 2 segments expected to dominate the market in the next 5 years. Both are looking at smaller homes. Millennials because they're just starting out, and boomers because they're downsizing. I can attest to this too. I am about to sell our 4,000 square foot house. Our kids aren't there. And quite honestly, even if our kids were a little bit younger, I would rather be vacationing and experiencing things than being, married to this home that we constantly are cleaning and mowing a lawn. So I do see that. I think a lot of people are downsizing, and that's another big reason that we believe strongly in sticking with these sizes: no bigger than 5 bedrooms, 3 baths, and then the 2,800 square feet. I think that is a true statement there. Property size less than a half acre. Land price is a fickle thing. It is harder to assess value. Acreage is often the first feature to forego for buyers seeking to economize. And both boomers and millennials are looking for smaller acreage. Boomers because they're getting older, and millennials because they're just starting out. Boomers dread the upkeep, yes, and expensive acreage. The millennial generation is seeking community and great swaths of land, make that a more distant goal. All of this makes these grand estates harder to sell, and I agree with that 100%. One of the other things with acreage, you're typically dealing with septics and wells and things of that nature. Those 2 items there make it more difficult to sell too. So, this is really all about getting into properties where you can make a profit, but you can also sell them really quick. But again, you can also adjust if the market changes and hold it as a rental. If you stay within these guidelines, these properties will cash flow in the event that the market changes, and you can actually change the strategy. And that's something we look at as fund managers. We meet on a weekly basis on the properties that we purchase. There have been times where instead of selling something as we're going into winter, we know that the prices are going to come up in the spring. We've put a tenant in it for 6 months, get it cash flowing, and then wait till the market comes back up.
Right.
But if you're buying those high-end homes and you're going outside of these guidelines, it makes it very difficult to change your course and go down a different strategy.
It does. And why are we getting more specific with the underwriting guidelines? Yes, it's for our own risk abatement, if you will, but it's also for the success of the borrower. But when we have long expansions like this, when the economy is growing for 10 plus years, you've got new real estate investors coming into the marketplace constantly, more and more and more. Well, the deals become harder to find the more real estate investors that are there bidding these deals up, and some of these real estate investors are brand new, right? So they've made a commitment to be a real estate investor. So they want to get deals done. So what they do is their personal underwriting standards stretch, and they get themselves into deals they probably shouldn't have. Or maybe they get themselves into a deal, but that deal isn't going to be able to exit very easily. So us as lenders, it's in our best interest, it's in our investors' best interest, and it's in the borrower's best interest to be very specific with the underwriting guidelines so everyone is on the same page and we give everyone the best opportunity to get into the deal and exit the deal and get the investor paid successfully.
Absolutely. I mean, if you follow these guidelines, you will have multiple exit strategies. If you get to the end and you can't sell it, you can always readjust, hold it as a cash flowing property. And we're seeing this in servicing. One of the things that you may not be aware of is we actually service all of our own notes, and we do outside servicing. I think we service about 450 notes right now. We have seen more requests for extensions over the last 2 months, which tells me that either they're not getting the projects done, or they're getting the projects done and they're not being able to sell them.
Right.
At least if you're following these guidelines, you have other options. You don't have to just sell it. Because you get to the point where you've held it so long, your profit is eaten up, you can't lower your price. Now you need to consider, okay, can I turn this into a rental? Can I sell it on a lease option?
Right.
If you follow these, you will have those options.
You'll have a higher chance to be successful. And one thing to really point out here is we're not lending out the bank's money via a line of credit. We are lending out our investors' money via our private equity funds. Our investors are looking for yield with safety. Keyword there being safety. When you start to see requests for extensions on loans go up, it makes investors a little nervous. Hey, why is this borrower not able to exit this property? What is the chances of them exiting at a profit at this point? So it's really not in anyone's best interest for to see extensions rise. Our fiduciary is to the investor, right? So it is very important to look out for their best interest first and foremost.
Right.
But the best interest of the borrower and the investor are in line with each other. So it's just our job as facilitators to lay out the platform to make that as easy as possible.
No, absolutely. And the other thing to mention is there's a lot of opportunity right now with 30-year loan products for rental properties. We actually can offer that to our borrowers. And so it's in our best interest to originally structure the deal in a way that makes them qualified to exit the original loan. Maybe it was to rehab it and purchase it. Now they've got it cash flowing. We have a 30-year product for a rental property that we can easily refinance them into.
Yeah.
So there's, like you were saying, people are yield starved right now.
Right.
There is huge institutional money out there that are offering, longer term paper, 30-year paper, but the key to that is from the time that you buy it and structuring it in a way that you have the ability to refinance into those. So, and we look at it from a as fund managers and managing the fund, we also look at it as worst case scenario. If deals are structured this way, if we ever have to step in and take a property back, there's more opportunity for the fund or a note buyer to stabilize the property, cash flow it, or something like that.
Right. I mean, we have to be in the best position possible to exit that property if the borrower couldn't.
Right.
Which is critically important. So everything is about hedging risk, right? And this is when we see the market really start to heat up, which it is. It's hot, right? The equities markets are up 30%, and they've been doing extremely well for the past decade. So as the returns get higher and higher and higher, so does the risk. And for most people, at least the customers that we serve, the investors we serve, they are more concerned about the downside risk than they are about hitting a home run.
Right.
So we're more concerned with the risk profile because of that.
Yeah. And this is a company-wide initiative. I mean, if you're a borrower or a broker and you're calling into Cogo looking for funding, this is going to be the same message you're going to get there. But I think it's really important and pertinent to talk about it in relation to the funds, because a lot of the members of the fund or people potentially looking at putting money into our equity funds have asked, what is your guys' plan? How do you guys manage a shift in the market? And I don't know that everybody understands how much management goes into this fund. I mean, there are weekly meetings that are met on, and that's in regards to servicing. We look at the overall portfolio. We look at problem accounts if we have them. Okay, is there some kind of common denominator? And this is where guidelines like this evolve from. We look at, maybe the common denominator is deals that are above the FHA cap that are getting in trouble because they don't have exit strategies. Right. So it is a moving target. It's something we talk about on a weekly basis. We meet on all the properties. I had one this morning that my acquisition specialist was ready for us to purchase. I ran the numbers, and the numbers didn't make sense. So I'm asking more questions. But you always have to be active and strategic and ready to shift and change direction in the event that the market changes, because we all know it's going to happen. We do, and the more likely it is going to happen, you're more concerned about the exit than you are the acquisition, because no one has a crystal ball, but you really need to be thinking, well, okay, when this loan matures, what type of economic cycle are we going to be in? What is going to be the buyer's climate? And being able to forecast that perfectly is impossible, but it has to be on the forefront of your mind. Just because you have a good deal today, well, how good is your exit 12 or 24 months from now? Right, yeah. So again, these are the guidelines we follow from a borrower broker standpoint, but this is also the guidelines of the fund. If you're interested in deploying capital in a passive way, the funds are a great opportunity. You're basically investing in the same real estate asset as notes and real estate, but you're not having to lift a hammer and deal with tenants and toilets and deal with a note not paying. Right. It's very passive. If you'd like to talk about that, you can call Erik or I at the office, and we can set up an appointment to talk with you more, get you more information. The funding number is 800-898-2717. Or you can visit our website at securedinvestmentcorp.com. Yes, I know I hit on this probably too often, but again, the markets are up close to 30%. If you're heavily invested in the stock market and you're over the age of, just say 40, be willing to take some profits off the table. Be willing to lighten your position in the equities markets and maybe shift some of those profits into an asset class that has little to no correlation to equities. Well, it's a great way to diversify. It is. Yeah. It is, and it is essentially true diversification. I mean, the correlation to the stock market is essentially zero. So definitely keep. I know it's hard to sell into these types of rallies when your portfolio or your 401k or whatever it might be is up 30% or more. Selling can be difficult, but think about it. I have had a lot of people thinking about it because they're getting nervous. It's too good, and I think we all were there in 2007, 2008, and I think, it's a valid concern to have. If you're not diversified into a real estate equity fund, now's a great time to look at that. We've been fund managers for over 6 years. We think we do a really good job at it. This is our third fund. So Erik and I would love to talk with you more about it. On a side note, we do have 2 events coming up. If you are interested in attending one of our events, our funding tour events, These are tuition paid, so it wouldn't cost you anything, but we've got 2 coming up this week. Get a hold of us. We have one coming up in New Orleans, and then the other one's in San Jose.
Yes.
So I don't know about you. I'd like to go to San Jose right now since it snowed today here. But you can visit our website at fundingtour.com, and you can actually get more information about that or get signed up for it.
Absolutely. We'd love to see you there.
Yep. And again, reach out to Eric and I. We'd love to schedule an appointment to talk with you more about our real estate equity funds.
Thank you, everybody. Happy holidays.
Yeah, happy holidays.